Hi everybody, Jeff Yastine here. Make sure to email me at jeff@yastine.com, and of course you can follow me on Twitter and on Facebook as well. So here's the question of the week. Airbnb, the software platform that allows homes and apartments to be used as short-term hospitality rentals, is going public. The company stock symbol is, what else? ABNB. So you're probably wondering, should I buy the stock? If you're just looking for the juice, the excitement of day-to-day trading, and you're willing to take on that risk, well, be my guest. Buy Airbnb. It's certainly one of the most anticipated IPOs of the year, and you'll have lots and lots of companies people pile into to buy the shares. But keep in mind, that's also the problem. Almost by definition, anytime everyone wants a particular stock, it's practically a guarantee that you'll pay a very high price to own it relative to profits, if it has any. Now, that doesn't matter if you're just speculating for the sake of speculating. But if you're trying to invest, you want to own a stock, let's say not just for a few days, but for months, hopefully, or for years. You want to buy it at a good price, and that's a whole other matter. So with that in mind, I would avoid the stock. I would be patient and look to buy it when you're not forced to pay a premium price. So let me explain what I mean by all that. As a business, Airbnb has a lot going for it. Much like Amazon or Google or Apple for that matter, it's a software platform. As a homeowner, you use the platform to make your unit available for short-term rentals. Airbnb takes a cut of every transaction and makes sure the owner and the guests live up to the terms of the deal. And according to the prospectus data, Airbnb generated $4.8 billion in revenue last year. That's up from $3.6 billion in 2018. The pandemic put a crimp in Airbnb's numbers this year, but analysts expect revenue to rebound to $4.3 billion in 2021. Airbnb has yet to earn a reported profit on the business yet, but the company generates good cash flow from its operations. But positive earnings are on the horizon. Analysts expect the company to post a pandemic-related loss of more than $11 a share this year, but with much smaller losses in 2021 and 2022. And if everything goes right, it should generate a projected profit of 45 cents a share in 2023. But here's the thing about the IPO. You will be paying a very high price now in order to get a piece of that 45 cents a share profit. That's still 3 years in the future. And a lot can happen, as we all know, in 3 years. Bear markets and sharp corrections that can drag down the price of even the best stocks. Take the example of the hot IPO of 2019, Beyond Meat, BYND, the maker, of course, of plant-based meat substitutes. That stock came public at $50 and soared to $200 in a few months' time. So if you're willing to take on the risk of speculating, like I said earlier, you can make some money. And if that's you and you sold at $200, more power to you. On the other hand, if you wanted to invest in Beyond Meat, with a longer time frame and own the shares for that long-term period, you're still barely breaking even unless you bought on the very first day of the IPO. And I warned about all this too. In August 2019, with the stock at $200, I wrote an article talking about how overvalued Beyond Meat was at that current price and said avoid it. By November, the shares had fallen 70%. I wrote another article saying, still not cheap enough. Then came the pandemic. By April, the stock was 80% off its highs of the prior year. I wrote a third article saying it was finally cheap enough time to buy, I said. Readers who followed my advice doubled their money in about 6 weeks' time. And after that, I said that the stock had run up to its full value again. And after a brief flurry higher, Beyond Meat's share price remains stuck at around $140 a share. So the company here doesn't earn enough profit to justify higher prices, so it has trouble moving any higher. With Airbnb, I suspect we're going to see the same situation eventually as it goes public. So if you want to speculate in the stock, go ahead. Know the risks. If you're trying to invest longer term, though, you'd be better off staying out of the stock until we get that next bear market the next sharp correction that knocks the shares down to a price where it's a true bargain and truly ready to buy. If you like what I'm talking about, make sure to keep following me on Twitter and on Facebook. I'm Jeff Yastine.